So today we talk about the decline of affordability in the housing market. There are some people who think that we are in better shape than we were in 2000, sort of 6, 7. Maybe we'll find out that's not the case. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy here, putting the realism back in real estate. Today is the 22nd of May. Hope everyone's doing well. Let's get into it right now. Now, first of all, guys, as you know, I do lots of interesting programs and training and seminars and events, etc., surrounding the distressed housing market. I got some stuff going on right now. The top 10 ways to earn income and build wealth in the housing correction or crisis. We are working on all sorts of stuff. I actually just got a payoff today that it was accepted after some arm wrestling with the lender and their counsel, so to speak. So that's good news. So stuff I talk about, we really do. Please reach out to me and talk, because you know the reason why is that, guess what? Things are changing. People are taking more interest in this market now. I do have some special offers going on, but really they're going to be done today. Like literally, I've been talking to people and everyone's been humming and hawing, but you know what? Time to move on. We're going to go big or go home with launching some of this stuff. It's a great opportunity to get in now before prices go really high when the masses want to jump in. All right, having said that, so visualizing the decline of the affordable housing in the US, I thought this was a really interesting article and kind of proves to where, prove positive to where things are at. So ultimately, in the end here, over 80% of US residents have chosen to live in an urban setting as of 2023. And we're going to take a look at some interesting charts information. That number is set to rise by nearly 90% by 2050. House prices are rising with significant consequences to housing affordability. So this next little segment will take a deep dive into this, okay? Excuse me, housing affordability is at its lowest ebb in decades. The U.S. price to income ratio, so really it's median price versus median price ratio, which tracks housing prices in multiples of annual income, has steadily climbed since the mid-1980s when the market was recovering from a real estate crash earlier that decade. Historically, the ratio has hovered between 3 and 4, but in the early aughts, the ratio passed 4 and kept going, reaching a high of 5.11 in 2005. So that was just before the previous housing boom bust crash crisis. The ratio fell somewhat in the aftermath of the subprime mortgage meltdown, but returned to its historical averages. New records were set in 2014 at 5.33, and again in 2021 at 5.61. So we're going to take a look at how that kind of plays out, which is very interesting. So they sort of map the U.S. urbanization. So clearly, where people are flocking to, where the growth is, etc. So this is tough to read. You can take a look at that. I'll just blow this up for the next chart here. So ultimately, in the end, in 2023, 83.3% of people in the U.S. lived in cities and urban settings, as opposed to rural or ex-rural type rural communities. So urbanization from 1970 to 2050, you can see it's going to increase dramatically. Well, has increased dramatically over the past couple hundred years. We'll be peaking at almost 90% mid-century here. Certain states, look, California, 94.2% of population lives in the urban areas, whereas you've got states, for example, like say Montana, which is only 53.4%. So clearly, places with lots of population, bigger cities, etc., are going to be higher on the urbanization percentage than others. But we can take a look at Nevada is up there, Florida's up there, Texas is up there. Clearly, the Northeast, we got D.C., Maryland, Delaware, New Jersey, Connecticut, Rhode Island, Massachusetts, New York, etc. So, basically things are high 80s to low 90s. That's what we're looking at as far as with respect to the issues. So it's interesting how that kind of plays out here, right? So anyway, that's what goes on. So obviously a lot of urban areas here. Let's go to the next slide. And this, I think, is kind of interesting too. When you take a look at the household ratio. So they did this back to 84. So we got a median house price to median household ratio, incomes, etc. So house price was 79.9, median income was 22,000 and change. There's your ratio. You can follow it through. This part of the chart goes all the way down to 2005 and 6. So you can see where it peaked at the bottom there in 2005. We were at a 5.11 ratio, which is kind of interesting. So it's basically had pretty much a steady growth, a little bit of a dip in mid 90s, etc. But it started to pick up the pace as we know how real estate changed over the past decade, or that part of the decade. Then I blew it up here. This is 2007. Well, okay, great. We had the 5.11 in 2006. Then basically it went down to 4.88. You could see it dropped a little bit, kind of hovering below 5. Obviously, once the correction occurred, 2014, and the market was manipulated, we started to rise again to the 5s. Obviously, 2014 was 5.33, and then we hit a little bit of a lull, of course, just before COVID with prices going up, and then during the COVID timeframe, hitting another high at 5.61. So again, this is the ratio of income required to cover the median here. So if the median house price is $396 and change, the median income is $70,000 and change. So the ratio, 5.61 times the median income is what it takes. Is I guess that's the ratio differentiation between the two numbers there. So clearly what this means is it's more expensive now than it was in the last housing crisis. So we actually have hit a higher number there. The decline of affordable housing. This is a good chart here. You can see that the first sort of hump in the middle is historically the ratios hovered between 3 and 4 and peaked at 5.11 in 2005. Part of a housing bubble that would lead to the financial crisis of 2007 and 8. Then we see a little bit of a dip, kind of a growth, dip again, and then it spiked up. So at the end of 2021, the ratio hit an all-time high at 5.61 times annual income. So big time numbers here, guys. So we really are at we'll call it the biggest disparity between wages and house prices, okay, on the median side. Now, I can tell you that a lot of people have said over the years, wage growth has been on par with home price values, etc. They're working together at the same growth pace. Well, clearly this is not. I mean, you can see there has been some differences there. It peaked, and it's almost like when it peaks, right? So yeah, wages are going up. There's no doubt about that, and they've increased dramatically, but so has the median price point. So it's one of those things. Have wages been pulled up by median house price points, or has it been the other way around? Wages have gone up, so people can, now in theory can afford a higher number. So not too sure what the driving force is there, but I think this is a good illustration that basically shows that, where we are today. Well, this is a pretty gross discrepancy or difference between wage price growth and you could say the house pricing stuff. So there's a big difference there, guys. All right, and first of all, if you enjoy the information I provide, if you could hit that subscribe button, I'd really appreciate that. Secondly, if you're already a subscriber or think you are, could you just hit the subscribe button again, hit the bell notifications, because I'm always losing subscribers compared to what's going on in the marketplace these days. Don't know why. All right, so as we go a little further here, this is interesting because housing data is available up to almost now. So we know that median prices eased off from a record high of 479.5 at the end of 2022. We're at 436 for the first quarter of this year. So remember, the number I showed you was 2021. So median house prices have continued to grow, but because median household income currently is only available up to 2021, it's not possible to calculate the ratio of past right now, really, you think about that, right? However, unless there was an unusually large increase in income, the ratio has likely remained near record high. So what they're saying here is that unless something really, kicked up that we're not realizing, ratio should still be at that high level here. It's one of those things that, I know the seemingly unstoppable rise in house prices over the 38 years covered above, income has failed to keep up. Between 84 and 2021, median income rose a factor of 3.16, while median housing prices increased by 5.26. All right, so there you go. So clearly, we're looking at over a 2.1 point difference in house price growth as opposed to median wage growth. So something to keep in mind here. Now, amid the steady erosion of housing affordability, U.S. residents have reacted with rising concern. Interesting here. In 2008, when the Research Center asked about major problems affecting local communities, the top spot went to drug addiction compared to 39% on the availability of affordable housing. In 2021, the situation reversed itself. Housing affordability was the number one problem, according to 49% of the respondents, an increase of 10%. Drug addiction, on the other hand, fell to 35%. So you can see that even communities are realizing this is not working, right? We can't afford to live here, et cetera, et cetera. In general, younger Americans 55% urban residents, 63%, and those with lower incomes, like 57%, express more concern than their counterparts. Well, of course, because obviously if you're in the urban or highly suburban areas, it's more competitive, it's more densely populated, more competition for housing, as opposed when you go to the rural areas where housing still is, relatively affordable in most places. Okay, this is funny. So what's causing the erosion of housing affordability? Ultimately, the U.S. is not building enough homes to keep pace with population growth. Well, see, this is interesting because there's always a few things that we'll call analytics fall back on as reasons why we have these problems. So, why we're not going to have foreclosures? Well, the response is, well, because we have tighter, and better credit standards over the past few years. Well, you know what? Foreclosures are spiking as well, too. All right. Income, wages, job loss, economy, all those factor into people not having enough money to pay their mortgages, right? Well, here it's saying that the U.S. is not building enough houses to keep pace with the population growth, all right? You can see this in the housing start data. Well, I understand that. But remember, and this goes back, they're going all the way back to January 1959, when there were around 1.7 million housing starts compared to 2023 when there were 1.3 million. So, and this decrease happened despite the fact that the U.S. population nearly doubled from 176 million to 335 million. So yeah, there's a lot of different forces sort of working here, lots of interest rate issues, this and that. But I guess with respect to, we're not building enough homes. Well, we are building enough homes. But remember, one of my last videos, we talked about the fact that you've got hedge funds and large investor groups and REITs who are basically buying communities and building communities. So it's one of those things where there is shelter. Clearly, there's a lot more shelter going on, multifamily housing, build to rent type housing. So housing starts are still going at an okay clip as far as I'm concerned, but maybe housing units that are being constructed aren't necessarily for purchase. So I think we're doing okay with respect to units and we'll call it shelter, because that's a different thing. But when it comes to purchasing, there's less units available for purchase. There's lots of stuff being developed today are rental properties. The multifamily is going gangbusters, even though they are slowing down. The past few years, there's been a huge number of multifamily being built. Again, the builders are still building homes. They got lots out there in inventory. A lot of inventory is still sitting around. People just aren't buying them for various reasons. And you've got the big players, the REITs, hedge funds, large investors who are, like I talked about JP Morgan asset, group, I guess, buying that property, 172 townhomes in Bradenton, just south of where I'm at. So, shelter is being offered, but not for you to necessarily own. You want to rent, there you go. So yes, there are things that are making life harder. There was issues. That's why as time goes on now, we're going to see a correction and some shifting. People who relocated may change. People who bought second homes may sell. There's still lots of investors out there buying these properties for rental. So, I think we're seeing a wealth transfer to shift right now. It's the way it goes. Clearly, interest rates and other things are affecting the marketplace. But I thought it was a good thing to talk about just because it really puts to bed the rest that, or puts to rest the concept that wage growth is not the issue with respect to affordability. Well, it really is. It shows in the numbers that housing, median house growth has far outpaced median wage growth. And that's coming out now. And so when you have price points that are too expensive, coupled with interest rates that are up 2 or 3% more than what people are used to, that makes it completely unaffordable and puts a strain on the entire housing market. So in the end, what has to happen? Something has to change. We all realize that. So that's a scoop, guys. So anyway, please connect with me. This is really important. There's a lot of stuff going on here. We're getting stuff done. We're getting deals closed. We're getting more deals we're on board. There's a lot happening in the marketplace right now. So I do all of these things or have access to all these things and participate in all these type of things. So that's what's going on in my area, my world these days. So reach out. I'm telling you, we're going to be going. People are already people are noticing that the distressed property markets where they're going to get cheaper houses. So if you want to get involved, jump on this before all those homes are being spoken for. So once again, thank you for the views, likes, and comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe, and we'll look forward to speaking with you later on this week.